Hi, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts and Chat for December 5th of 2022. Your disclaimer for important information. Welcome everybody to December of 2022. This will be the first broadcast of the last month of the current year, and so what better place to start than on housing, which I've seen some of the most dramatic data that I've seen in quite a while. Now, we knew that there was a lot of froth in housing last year, a lot of unsustainable gains in home prices and things like that. And we're seeing the comeuppance of that right now. Looking here at pending home sales, year over year, down 37%. And you can see the spike prior to that and the gyrations related to the pandemic. And then you've got to go back to the global financial crisis in 2007 to 09, and then that resulting shock in 10 to 11 before you can get to numbers that are this bad. In fact, these numbers are actually worse than that right now. So major dislocations. You can talk to any real estate agent and they'll tell you how things have changed in just a short period of time. Here's a Case-Shiller number, 3-month trailing average in home prices. It really does smooth out the monthly gyrations to do a moving average of several months. And so this gives you better explanatory power of actually what's going on. And what we're seeing now is that nationally home prices are down over 2%. And you can see what I was talking about in the prior slide. You know, we were consistently over 4 for like well over a year. Again, unsustainable. And now we see the day of reckoning. And you've got to, you go back to like 92 on the left-hand side here. You go back to the global financial crisis. I mean, we've seen meaningful negative trends in home prices, but in 92, 90, 91, that recession, we weren't witnessing the kind of froth in the market that we have been over the last year. And even during the leading up to the global financial crisis, we didn't have, the huge, literally the huge monthly gains that we did last year. We had a long buildup to it, but here you can see that this has really reversed itself quite a bit. And so the housing market is clearly a headwind for the U.S. economy. Here's Federal Reserve money supply. As I've talked about this a lot over the last several weeks, there is really, in my view, no better determinant or indicator about where inflation is going to go than this chart right here. And so with all of the spike that we saw due to transfer payments, government checks, monetary stimulus, things like that, money supply growth on an annualized basis at several junctures was like over 60%. It was just absolutely unreal. On a year-over-year basis, you can see here it was closer to 30 at one point, but that's really trickled off now, and we're barely positive on money supply, and we haven't seen this since the mid 90s, honestly. And so, like I said, there's really no better indicator of where inflation is going to go than this chart right here. If you take the punch bowl away, all the excess liquidity, the money supply that fuels purchases, right? That fuels inflation. You take that away, and eventually inflation's going to go away with it. And it may take a while, but this is what we expect. And so this gives me a lot of comfort, honestly, in the pace of inflation and the pace at which the Federal Reserve may begin to curb its rate increase activity. Now, these are all wild cards right now, but I don't think people are spending enough time on money supply to say, if you have the chart that looks like this does right now with 1.3% year over year money supply growth, at some point you're going to see that transmission into the economy, and it's going to slow inflation down. I think we're already seeing that right now, but I think the magnitude to which it could happen may happen sooner than some people think. And so, again, the next 3 to 6 months are going to be pretty critical in watching this data. But the trend in money supply is extremely, extremely helpful to eventually getting us to that next market upcycle. Here's a chart from FS Investments showing you the Bloomberg Financial Conditions Index in the orange line overlaid with the S&P 500 in the black. And this goes back to the end of 2021. So this is just a relatively brief snapshot, but you can see the positive relationship between these two. I mean, they're really on top of each other. And so everything in that gray shaded area represents less accommodative financial conditions. And that's where we are now. That's where we've been, honestly, for the bulk of this year. But they're becoming less negatively accommodative. And that area above the zero line on the left-hand margin is in that non-shaded area represents more accommodative. And so, there's puts and takes from this. One, obviously, the market has bounced from an interim low, and so people are trying to draw some conclusions as to what the upside power of the market is. Obviously, you cannot have earnings erode. We're going to talk about earnings here in a little bit, but absent that kind of discussion, it really does depend coincidentally on Bloomberg, on financial conditions overall. And I do think they are trending up. However, what we see though is that, the greater the trend is, or the more positive the trend is in financial conditions, and the more positive the trend is perhaps in the equity market, the less willing the Fed is going to be to kind of take its foot off the accelerator. They see this as not impacting behavior enough to want to stop soon. So just like what I said in the last slide is, I think money supply growth is going to choke off the economy. If you have financial conditions that are continuing to expand, that kind of offsets the benefit of that in terms of looking at what the Fed might do, because all of this is going to tie back to how quickly do we reach kind of that peak interest rate level, and then how quickly does that peak interest rate level help to choke off demand and help to slow the economy down so that inflation becomes a non-factor. That's what we're trying to achieve. And so, it's interesting that we have a few of these things that are kind of working in different ways here. A couple more charts on the market. This is kind of like real boots on the ground kind of data. We've got outstanding credit card debt. And then we have median housing payment as a percent of median income. And these are both important for different reasons. On the left-hand side, we got credit card debt. We've known that this is happening, and this typically happens in this part of the cycle where things slow down. You have inflation, so things cost more. You have a situation where real wages are not going up. In fact, they're going down. Real wages, in some cases, real wage growth is actually negative right now. And so people are finding it a little bit more challenging to, put food on the table and gas in the car, although that's been helped out lately. But, inflation in a lot of areas has pinched people. And so, but they want to maintain their consumption levels until things really become apparent that they've got to change their habits. So what happens? They go put those charges on the credit card, so those balances go up. And then we see the stress here on the right-hand side, and the change has been pretty dramatic. We typically don't see something that moves out of line this fast, but literally at the end of last year, it was around 33%. Housing payment as a percent of median income, but as we've seen, mortgage rates more than double, clearly more than double, even though rates have come down actually pretty interestingly, pretty dramatically over the last couple of weeks. But even still, they're pretty high, and they've more than doubled. And so that impact and that coupled with housing prices moving up as well, has caused the overall burden on the average homeowner to be relatively high. Here's a Census Bureau number for something I also thought was interesting, reported to us by the quant strategy team at Bank of America Merrill Lynch. But this is a percent of the respondents in this survey that say that it's difficult paying their expenses. And so, this is a household pulse survey, so presumably it is homeowners. And I don't know what the sample size is, but I do really love the work that the quant team does over at Merrill Lynch. And this information is powerful. This is a sign that things will slow down, because if there's more stress within the household, then there's going to be less consumption. And that demand destruction is exactly what the Fed is looking for as a signal to slow its rate increase. So not that they're necessarily looking at this chart and this data specifically, but they're looking for that demand destruction, which again, just as I said, with money supply going down and all of these things at work, that we get to a new upcycle faster, the sooner that all of this takes place and kind of plays itself out. And, as we talked about money supply, I mean, this is the other side of it. And these two are obviously related. So, you've got the Federal Reserve reducing the size of its balance sheet. April was the peak. And then they started consciously trying to reduce their balance sheet. And they've reduced it about 400 billion coming off of a base of 9 trillion. So let's not get too carried away. This is the start of what should be a continuous trend that probably doesn't end for years as the Fed continues to draw down its balance sheet. But in effect, what this is doing is it's taking liquidity out of the market by virtue of the fact that the Fed is not putting it back in. When these things mature, they're not continuing to increase the size of their balance sheet. So they're essentially pulling liquidity out, and they're reducing the money supply by doing this. Here's a quick look at ISM Manufacturing Index. Again, manufacturing is a component of the economy. Services matter a lot more, but I'm using this as kind of like to highlight the predictive power of what the ISM data typically tells us. And so, you've got in the darker blue the actual production numbers out of this index. The light blue is new orders less inventory. So that makes it a little less volatile because inventory build or growth or contraction can be pretty volatile in its own right. But if you subtract out inventories, then that new order number, is smoothed out a little bit. And obviously, because this is from the same index, I mean, you tend to get data that sits right at the top of each other. And you can see going back into 2001, new orders, less inventories, led us into recession. And then you can see in the global financial crisis, 2008, 2009, same deal. Now we've had several kind of false positives in the sense that we've had new orders that have gone below 50, which is contractionary, several times, and we haven't gone to recession. But and then obviously the pandemic, we had another episode there. But I think the numbers on new orders are powerful enough that it does signal a recession. I do expect production numbers to follow. Here's ISM looking at it in a different light. It's the same data, plotted a little differently going back to 2007. So you're looking at roughly the same timeline as we had on the prior chart. But you can see here the overall PMI in blue is 49. So it's in contraction territory. Anything below 50 represents contraction. It's not contracting by a whole, it's not, in seriously negative contraction territory, but it is there. And then we see both business employment, 48.4, and new orders at 47.2. Again, I think new orders are going to continue to trend down. They're going to follow the PMI. Employment is trending down. I think that's going to follow the PMI. We've got charts later on hiring intentions and layoff announcements in certain sectors of the economy, and it's pretty powerful. I mean, we are clearly seeing erosion in the labor market right now, even though it's coming from a very strong position. There are chinks in that armor, but you can see the ISM here clearly kind of flowing into contractionary territory. Here's excess savings. So we've showed you this chart. Actually, personal savings, we've showed you both of these charts here recently. So this is not treading a lot of new ground, but it's just like re-emphasizing all of what I've been saying about liquidity in the market, what consumers are doing in the meantime. I call this kind of like an interim phase. Obviously you have you have a phase where the market is moving higher. And people are building up their savings because incomes and especially real incomes are good, inflation's low, So you've got that personal savings rate that tends to trend up in an upcycle. Well, that reversal happens as you transition to a slower period of growth. So people clearly want to maintain their lifestyle, they want to maintain their consumption. We already showed you they're putting money on credit cards, but they're drawing down their savings too. And you can see left-hand side, the little blue bars that are negative show you that they've been consistently drawing down to a greater degree their savings. Now, personal savings on the right-hand side has been going down for several months as well, and that could really hit zero. And obviously that puts us in a very interesting and relatively, extremely rare, actually, not relatively, extremely rare position if we continue to work down our savings levels as we have. My theory on this is that at some point you reach kind of a limitation, and you really can't have negative savings unless you're putting everything on credit, and that's not practical because then credit standards are going to tighten up, and then you won't have credit available and you just won't spend. And I think at some point we'll see spending curb again. That's the demand destruction that the Fed wants to see. You'll see personal savings rates and excess savings really kind of get down to a trickle, and it's going to get us to the point where we have to, we'll go through that transition period through recession and eventually into that next upcycle. Well, in looking at the consumer, obviously there's a lot of variables, and given that the consumer is 70% of the economy, it's really important that we look at consumption capability. We know the consumer is still plowing through. That's that, as I mentioned, that next that interim phase between an upcycle and a down cycle, or at least a correction or recession or whatever you want to call it. The good news here is that while consumers are drawing down their savings, their balance sheets overall are pretty good. Household debt outstanding as a percent of total GDP, it's above the long-term average, but it's well off of its peak that we saw back in the global financial crisis. We see these debt levels have gone consistently higher, dating back to basically the Truman administration, for crying out loud. And then they definitely reversed after the global financial crisis. And if you take out the pandemic, the overall trend for the last 12 to 13 years or so has been down. And so consumers are in a better shape to weather an increase in credit card debt and things like that. Consumer balance sheet's still healthy. That's on the right-hand side. Financial obligations ratio, which is a seasonally adjusted percent of total obligations as a percent of disposable income, you see that's relatively low. So again, while the consumer is in this transition phase and they're still operating under the mindset of, I'm going to maintain my consumption, I'm just going to do it a different way. If I can't do it from income, I'll do it from savings. At some point that stops, but while we're analyzing what's the impact to the consumer, we can sit here and look at this data and say, listen, they're coming into it at a better place than they have previously, and so they should better be able to weather it. Well, we'll talk about the market a little bit. No need to highlight the fact that this has been a bad year for investments. I've talked about this. I've shown you data tables. This is more visual, but on the left-hand side, I mean, it highlights just how absolutely unusual the current environment has been, where the 60-40 portfolio has been negative, and this is a number that its current level is better than what's being reflected in this red line for 2022 right now, but it's still very negative. And you can see, you can go back and literally count the instances where we've seen kind of contractions in that 60-40 portfolio, and they're very few and far between. And you can see the preponderance of occurrences where that 60-40 portfolio is positive. In fact, if you go back all the way to 1920, if you reinvest dividends on an annual basis, that 60-40 portfolio is returned over 9%. Now, if you go on the right-hand side, this is a big reason why that 60-40 portfolio is looking so bad, and that's because bonds have really been the anchor. Honestly, bonds have been the anchor to performance. As bad as stocks have been, bonds have actually been worse. And if you look at government bonds and just look at kind of a 10 to 20-year bond, that's had a huge negative impact. And you can see here, this data series goes back to 1700 for crying out loud. And you can see how infrequently the current return levels are looking. I mean, that long bond is down over 20%. It's performing a lot worse than the equity market. And so by B of A Global Investment Strategies opinion, by this work here, this is the sixth worst annual returns in 1700. So we talk about, the health of the economy, and we talk about the health of companies that are in the stock market. And so, looking at sales, which is kind of like the mother's milk for earnings and earnings growth. I mean, we've had differences across the spectrum, right? And so you've got basically about half of the companies in the S&P 500 that have shown positive real sales growth. Now, if you go into different sectors, like obviously energy has done very well this year. So most of those companies are reporting positive sales. But on the other side, you've got healthcare, which those folks are not doing as well, but tend to have better investment valuations right now. Staples, financials, those people are showing less real sales growth just because they typically don't show a lot of growth anyway. Tech is being in the process of really being re-rated, if you will. Multiples have come way down. Valuations have come way down for tech. But here you can see that there are differences across the board as far as like which sectors are contributing to sales growth or witnessing sales growth and which ones are not. Well, as we continue to work to look at the investment backdrop and where we sit, obviously we spend a lot of time with earnings and valuations on the equity side, but then on the fixed income side, we just talked about how terrible the long-term bond returns have been this year, and kind of how unusual that is. But we're in a weird environment. But what's interesting here is that as we tread into what I think will be a mild recession, honestly, you can't see it in the credit markets. These are bonds that, the credit spread, if you will, is the difference between the risk-free rate, which is generally presumed to be the treasury bond, and the yield on the, corporate, commercial, or, private issuer of credit. And so, and you have credit spreads to help ensure, if you will, or compensate rather, the investor for the risk of default by the credit issuer. And usually when you see the economy slow down, you see those credit spreads blow out, and then you wind up eventually backing that up with real data. And you can see here, this is banks' net charge-offs as a percent of total loans. So, these aren't like corporate bonds, if you will, but these are actually bank loans to bank customers. This is essentially middle America right here. And it's telling you that we haven't seen a real big spike in charge-offs yet. And again, typically you see that when you hit a recession. It just hasn't happened yet. And here's two measures of inflation that I wanted to highlight, and there's a reason why I want to highlight it here. You've got in the red, you've got the personal consumption expenditures. This is the Fed's preferred way of looking at inflation, and then you have the CPI in the black, and that's what we all read about in the newspapers. And obviously, there's a core rate that comes along with that backs out food and energy. And as you might expect, there is a good relationship between these two. Now, the PCE number, the personal consumption expenditure number, tends to be less volatile than the overall CPI. And oftentimes, like we have now, you have a CPI number that's kind of overshot, right? Because energy prices and food prices have been high, and food prices are still high. But you see a PCE number that's actually meaningfully less than that right now. And so, basically there's usually when you have these extremes, because the CPI is more volatile, you'll either kind of catch up to where the PCE number is or catch down to it. And I think Uh, I think that's what is apt to happen here, is that you've got that CPI number, which, yeah, again, you can clearly see here in both of these numbers, actually, that inflation probably has peaked, is coming down. That's very demonstrable. Obviously, that's what we all want. I think this is helping to improve the rhetoric coming out of Jay Powell's talk last week that I think the market is completely focused on. It's maybe the slowing in the pace of these interest rate increases, um, or slowing in the magnitude of the rate increases that are coming. So everything's moving down. That's positive, but I think you see that black CPI number begin to trend closer to that red line, and see inflation down, probably by the middle of next year, closer to around 5% or so. Here's the labor charts that I wanted to highlight. We've got on the left-hand side year-to-date change of monthly new employment listings, and you see this, across the board. It's down. In some cases, down by quite a bit. We know tech has been really soft as of late. A lot of announcements there. In fact, you look on the right-hand side, these are challenger job cuts announcements, and we were waiting for the challenger data to come out because it's kind of a harbinger of where large companies are in terms of their hiring intentions, and it was down meaningfully. But as we see here, the job cut announcements by technology have really jumped through the roof. And you can see that, as recently as September, it was still within the trend line, but really November, and then especially, heading into the current month, technology layoff announcements have really gone through the roof. Fixed mortgage rate, we've already talked about this, going from 7.08 to 6.49. We haven't seen a short-term decrease like that in at least 14 years or so. But still, from an aggregate basis, extremely high. Here's our Chicago PMI, and this something that I saw in one of Liz Ann Saunders' tweets this past week, and she's with chief investment strategist for Charles Schwab, and she noted this. I had missed it. Chicago PMI down to 37 in that region. That is amazing, and you see the cyclicality of this type data, but that move down, that leg down, is actually very dramatic. Again, all going to this notion of a demand slowdown. Here's an overlay between the S&P 500 and the U.S. dollar. So obviously the equity markets have improved. S&P 500 has gone up lately on balance. Dollar has eased off, but I thought this was particularly interesting because they are both bumping up against their 200-day moving averages. And this data was from the 29th, so roughly midweek, and we saw a little bit of volatility, a little bit of vol at the end of last week, but both of these are bumping up in different ways on their 200-day moving averages. Well, this chart is a little bit busy, again, giving us a view into the S&P 500, and it has a little bit more of a technical trader view to it. And so you look at these trend lines, and the one that we spend a lot of time looking at is the 200-day moving average. That's a longer term type moving average than some of the other ones that they have here. They've got actually the 20-day in the amber. They've got the 100-day in the blue, and then they also have the 50-day in the black there. But the red one is one that I want to focus on. And back in last March, again, we had a sell-off heading into the year. Then we had a bit of a rally in March, and it actually overshot this 200-day moving average. And oftentimes you see that crossing over the 200-day moving average. It tends to lead to continued stronger performance. But it was a decelerating moving average. And, as you can see here, the red line is clearly rolled over. Well, now we're kind of testing that 200-day moving average once again with this current rally. And so, again, to think that we're almost, we're up almost 20% from our lows on some of these indices, which would actually note a new bull market, if you will. So it's been a very crazy environment for parts of our market and some of these indices. But just highlight to say that this could be this next phase of consolidation where it hits over the 200-day moving average, and then we see maybe another leg down again. So we want to guard against that and not get too aggressive right here. Well, we see equity valuations here with the latest leg up in the market have gone up a little bit from around 15.5, 16 to about 17.7. So again, we're not cheap. We're off our peak. But we're trending along here, and probably a little bit more downside. Now these are price to earnings ratios. So really the big thing that we're worried about now is earnings, and how much can you put stock in earnings when we see that obviously a lot of the S&P 500 is not witnessing sales growth, and so eventually that translates into earnings, and then obviously, if you're not growing sales, then you have less overall activity to help cover fixed costs, which are higher, wages, inputs, those types of things. So again, takeaway from here, valuations still cheaper, clearly cheaper than they were last year. Not necessarily attractive yet, but not too bad either. S&P 500 over a 4-year presidential cycle. The blue line kind of gives you that 4-year kind of historical cycle where they plotted all of these different years. You can see, basically the midterm cycle, you tend to always have a more difficult market. This year is obviously down when it's usually kind of sideways, but you tend to have a better year when you're in the pre-election cycle. Again, not that, I'm hanging my hat on this because right now our trend is down and we're heading into recession. But I think it's a fair bet actually to say, we enter 2023 in kind of a weaker note perhaps, but that we wind up exiting 2023 on a more positive note. I've shown this chart a few times, and I've got two charts which will kind of go back to Financial Planning 101. And this is, again, with the Treasury bonds performing so weak, the 60-40 portfolio really having a tough year, and and looking, a lot of investors looking themselves in the mirror and kind of like scratching their heads at like, the craziness of this year. If you look over a long term, if you have the power to look over a broader investment horizon, the outlook is actually a ton better. If you go on this chart, and this is such predictive power for financial planning purposes, if you go out a year, there's only basically a 26 in 100 chance of there being a negative return. And if you go out 3 years, the chance of having a negative return in your portfolio over that 3 years is only 16%. And 5 years, it goes down to 10, and then 10 years, it's 6. So, all of these like millennials and post-millennials that have a long time to retirement, I wouldn't skip a beat here, looking for opportunities, obviously being prudent in the downturn, being prudent while you have volatility. But if you look out 5-10 years, your probability of loss in your, at least on the equity side of your portfolio, and I'd say, obviously since losses are extremely rare in fixed income anyway, that the loss on a 60-40 portfolio is extremely low when you get out on the horizon. So if you look here, this is one of those charts that kind of tells you if you missed the best 10 days per decade, and there's been lots of analysis done that I actually think is pretty interesting. But if you just held and kind of worked your way through the markets and, did prudent things during the interim, but you didn't get out, you didn't go to cash. Since 1930, you would have had about an 18,000% return point to point. And if you had excluded the best 10 days per decade, that 18,000% return would have gone to 30. You really would have torpedoed your performance. Now, of course, if you'd had the clairvoyance, again, also to know to avoid the worst 10 days per decade, then your return would be considerably greater. But if you somehow had the clairvoyance of excluding the best and worst 10 days of the market, your return will be higher. But the problem is nobody knows how to time the market. But if you are out of the market, you're clearly not, getting the benefits of it. And so, my point in all this is to say, if you're invested through the downturn, maybe you tweak your allocations. Maybe you raise a little bit of cash. Maybe you try to reposition part of the portfolio into higher performing areas or things that you perceive to be higher performing. That's okay. That's managing a portfolio. But don't be out of the market. Don't tell yourself that I have to get out, because getting back in is hard. And if you miss those 10 days, and oftentimes the next market cycle happens before you even realize that it's happening. And if you do, you can see here clearly that you miss a ton of return. S&P 500 average negative sentiment. We see corporate sentiment here in the dark blue, and that has been negative. We've seen that trend throughout this year with higher inflation. EPS, getting back to this whole concept of, where valuations are, and if they're about 17.7, which is not cheap on a price to earnings basis, but what happens to earnings? Well, I think this is showing you here that quarterly earnings per share year over year. Again, this is lagged by a quarter against that corporate sentiment number, but because of this tight relationship, I certainly do expect earnings to come down. And so that inherently makes that price to earnings multiple a little bit fatter. And so, we've got a chart coming up that's extremely busy that it's a little bit of a sobering view on what really has to happen given where we are now. But I do think that this chart is suggestive that earnings will come down. Now, here's that busy chart. This is a data plot of every quarter from 1965 through the present, and that curved line of best fit, if you will. And this is not a linear best fit. This is a parabolic, meaning it's a curved line best fit. And so, that red dot, December 2021, you could see that initial dot there, and that bigger dot, which is where we are currently. So, what this is telling us that, where we are at current inflation levels of, over, 7-ish%, that the implied price to earnings ratio would be closer to around 11. And that's that line of best fit, if you will. And similarly, at the implied inflation level at current price to earnings levels, which again, about 17.7, 17.5, whatever, the inflation would be around 3%. So, this is suggesting that something's got to give here. Either, inflation is going to come down at a much faster rate, or that multiples are going to have to really contract. Now, if we go from 17.7 to 11.7 times earnings, that's a significant move in the market. My opinion is that we probably have a little bit of both. Obviously, inflation is coming down. We see that. And I do think that over time that we'll continue to see a little bit of volatility in the market because earnings are likely to slow. And something that we've done portfolio-wise, like over the last year, is really try to de-emphasize emerging markets with the strong dollar. The strong dollar is generally not as good for emerging markets, or is it generally good for commodities? But again, we live in a weird world, but indeed, the emerging markets have been battered to a large extent. We've had significant outperformance of U.S. stocks. Now, not to say that it can't continue, it's just to say here statistically that we're bumping up against a pretty big level. When you get a standard deviation away, this would tend to suggest that emerging markets at some point are going to begin to maybe outperform because they are a lot cheaper. They've just lacked a catalyst, and obviously with the dollar being relatively strong, that's been a headwind. But if the dollar evens out or maybe goes the other way for a little bit, and then especially if we hit a new economic cycle, like say within the next 12 months, then you would expect emerging markets to do a lot better. So as we go into the new year, that's one of the things that we're really going to be looking at is the viability of international investments again and the viability of emerging markets, even if you start to dip your toe in and begin to get invested there. And the last chart we've got today is on volatility. And so, you look on the left-hand side from Charlie Bolello, year to date, we're about 25, 26 times. So, we've had periods where we haven't had any volatility, and then we've had periods of a lot of volatility where we've had like a number of these very large 2 and 3+ moves in a day. I mean, just uncanny moves like that. That's made it very difficult to manage, as we've talked about ad nauseum here. But you look at the years where we've had more average volatility, and these are clearly recessionary years. 08, 09, 2002. And 2020. And so this has just been a very difficult year to manage. Now, volatility is not a linear phenomenon. It comes and goes, and that's what you could see on the left-hand side. So, in March we had a decent market, and that resulted in lower volatility. That's number one. And this year we've seen really our volatility really perk its head up more so on the downside when markets are selling off than when they've been being bid up. But August into September, we got in that post-June euphoria phase, volatility dropped again. That's number two. And then number three is kind of where we're at now. And so this is just saying that everything we've been talking about with regard to earnings slowing down, and where multiples are, and with the economy slowing and trending into what could be and what probably will be a mild recession here coming up. And all the data points seem to show that right now, but the market's been good. So I think we should button ourselves down for another bout of this spike in volatility, which again, equities could go down 5% or so. Again, we're holding cash in a lot of portfolios. And so, we want to be smart investors, but we don't want to, play too many games with these bear market rallies. We really want to be strong and motivated investors when we're pretty clear that we're seeing the next market upcycle. But again, to the point of not wanting to be out of the market during the best days of the market, which typically happen when you have a new market cycle, we are invested, but we're just trying to invest prudently. And so these charts, I think, help to paint the picture of why we're doing what we're doing, and just being aware of the data, because data is very, very powerful. What we've got this week, I thought it was important to kick off the month with a good set of educational charts to kind of get you prepared for what I think we're going to see over the next several months. Certainly want to answer any questions you have. There's my information. Hope you have a wonderful week, and we'll talk again soon. Take care. Bye.